Income averaging. If you have a property that has income averaging, make sure you're paying attention because it's very important and it's going to be a lot different than what you're used to. So make sure you're paying attention to this. In 2018, the IRS came out and said, all right, we're going to allow owners to do income averaging, which means they're going to be able to have more elections as it relates to set-asides. We were all used to you're either a 20 at 50 or a 40 at 60. That was working for a long time, but then the IRS said, oh no, we're going to allow them to pick additional set-asides. When the original rule came out, some people were happy, some people were not happy. All right. One of the biggest issues that everyone had is that the IRS said the units had to be fixed. So if Unit 101 was a 30% unit, until the end of time, that had to be a 30% unit. All right. Well, that was in conflict with our state policy because we said your units have to float, because you want to make sure that people are in units that are applicable to their income and what they can pay, and for a variety of reasons being able to manage compliance. Of course, your syndicators are following the IRS because the IRS says, if you don't do it this way, I'm going to take your money back. All right, well, so the syndicators were essentially saying to North Carolina, we respect you in the job that you do, but they're going to take money back, so I'd rather deal with them than, make it right with them, and then I can come in later and clean up the mess with you. All right, a lot of people didn't like that as it related to making them fixed. They went back, and the IRS looked at it, they heard what everybody said, and then they came back and they made some changes. All right. Of course, some people are happy now, some people are not happy, but one of the things that they did change is now the units are allowed to float. All right, so we're going to talk about some of the changes and how that impacted North Carolina's policy, because I will go ahead and tell you, it didn't impact it a lot, if any. All right, so be prepared that what we're talking about is about North Carolina only. One of the things that the IRS had in place before was known as the cliff test. If you messed up, you lost all credits for the entire building. All right, it wasn't one of those things you just lost it, for the entire property. You lost it for the entire property, not just for the building or the unit that you had the issue with. All right, the cliff test is gone. All right, so there's no cliff test anymore. All right, now you can still lose all of your credits, and we'll talk about how that will happen or can happen. Hopefully, you'll never do that. But just know that that has gone, all right? So now we're going to talk about North Carolina's policy. If you work in another state, this is only about North Carolina. Don't go back and start implementing these rules in another state. So our policy states that you can only elect average income on new construction properties. If you have a property that has a LURA already on it, and management or the owner wants to come back and do a rehab on that property, if there's an existing LURA, you cannot choose average income for that property. All right, it's only good for new construction. All right, the IRS's rules allowed developers to choose this option beginning in 2018. North Carolina's policy says you can only begin electing this in 2019. So it did not become an option in North Carolina until 2019. Here are some of the things that you have to comply to be in compliance with the North Carolina policy, and I will point out them as we go if they are an IRS or state policy or if there's a difference. The income average for the property cannot exceed 60%. That is both IRS and state. All right, so both policies require you to meet that requirement. This next one is a state policy only. The income average for any bedroom size has to be 60%. So all of your one bedrooms have to average at 60, all your two bedrooms, all your three bedrooms. That is a state policy. All right? Market rate units are prohibited in North Carolina. The IRS allows you to have market rate units. All right, but again, in North Carolina, we are not going to allow you to have market rate units. All 100% of your units must be affordable. All right, for projects with more than one building, we just talked about this and how they make the election on the 8609. Are you going to stand alone for each building, or is it going to be considered a multiple building project? In North Carolina, you must elect the property is going to be a multiple building project, and it's all going to be looked at as one. You can't elect the option for each building to stand on its own. All right. In North Carolina, you can only choose up to 4 income bands. The IRS allows you to choose more, but in North Carolina, you can only choose 4, anywhere from 20 to 80%. So the owner elects, am I going to have 20% units, 40% units, and 80% units, or what are they going to elect? They can do up to 4. So in North Carolina, you should only have a maximum of 4, all right? Also, if an owner elects average income, it's going to require a higher monitoring fee, that they're going to pay that up front, of course, like they do all of their monitoring fees, because we're going to be monitoring it more frequently, and there's more involved in it. So if an owner elects average income, just know that they've paid a higher monitoring fee. So we're going to look at an example as to what average looks like, and then we'll go to lunch and we'll come back. But what I will encourage you to do in your book on this slide that we're getting ready to go over, make a note on this book, on that slide there. And the reason that I say that is, remember when you were in school, you wanted to use a calculator because the calculator could tell you how to do it? Well, the calculation that we're getting ready to go through shows you how to do it longhand. So if you don't have things in place at your office that will do the calculation for you, we're getting ready to show you how to calculate if you're meeting the average income rule. All right, so this particular property has 100 units, and we've given you the breakdown: 30 units at 30, 20 at 50, 20 at 60, and 30 at 80. So you've got to calculate, is this property meeting the average rule, income rule? So this is how you do the calculation: 30 times 30, 20 times 50, and so forth. All right? And then you're going to divide them by 100 because there's 100 units at the property. This property is at 55%. Are they at or below 60%? So they're meeting the average income rule, correct? Yes. All right. This is how you make that calculation. All right. So if somebody says, how do I do that? Or if you want to check behind your computer, because remember, garbage in is garbage out. This is how you do the calculation. Yes, this is a very simple calculation, but we wanted to make it simple so you could at least follow the math and understand how it works. Now, we talked about you also have to do it on bedroom size as a state rule. All right, so you're going to have to do this for all of your 1 bedrooms, all of your 2 bedrooms, and your 3 bedrooms. So in this particular property, you have 33 1-bedroom units, it looks like. All right, so you've got to figure out for your 1-bedroom units, are you meeting your average? So you're going to do the math the same way. All right, they're at 48.18%. Are they at or below 60? All right, so their 1-bedrooms are meeting that state rule, right? Does the IRS care about the bedroom size? No. All right, so that's not going to be an IRS issue, but this is a state issue. All right, but you're going to have to go through and do the same thing for your 2 bedrooms and your 3 bedrooms as well. So again, if your software is not calculating that for you, you need to know how to calculate that. So we provided the calculations for you so you can follow that. We talked about earlier where the IRS originally said the unit designations were fixed. Now they're floating. So just because I start out as a 30 doesn't mean that that particular unit's always going to be a 30. It may become a 50 or an 80. So that's a good thing. All right, and so here's an example of what it looks like when a unit floats. All right, so you have building 15, and although it says building, we're assuming this is a 1 building property. All right. As of December the 31st, 2021, you had all new move-ins, and here was their set-aside. All right. Life was great. Everybody was happy. All right. Well, then the building average was 56%. Are you at or below 60? So you're good with that. All right. So then at the end of the following year, at the end of 2022, you notice that some households have recertified. You notice some households have moved in. So you had some people move out. You had some people move in. All right. So you notice that your unit E in 2021 was an 80% unit. But at the end of 2022, that's now a 50% unit. And you see how the set-asides floated across your particular property, in this case here, this particular building. All right, at the end of 2022, even though the set-asides floated across units in that particular building, that is still 56% for that particular property. So you're at or below 60, so you're still meeting the average income rule, at or below 60. All right. Some additional compliance requirements that we have in North Carolina is that we do require you to annually recertify your households if the owner has elected average income. That is not a IRS rule. That is a North Carolina rule. That is one that people don't necessarily like, but that is not one that we changed, so we're still sticking with the annual recertification. Now, if you have a household and they move in and their income is increased to the next set aside, the next available unit of comparable or smaller size must be rented to the household at the lower set aside. For example, if I move in and I'm a 30% unit, my income goes up and I now become a 50% unit. All right? Your next unit that becomes available that's at or a smaller size has to be rented to what set aside? 30, because you have to bring the building back into compliance. So make sure that you're doing that. Now, the flip side of that is if I am in a 50% unit and my income decreases, our state does not require you to move them down to the lower set aside if you have one available. Now, my recommendation is if you have that option, you should do that. Because if I'm not making enough money, what does that mean I'm not paying? Your rent, which then means you're going to turn around and end up doing an eviction. All right, so we encourage you to do that if income decreases, but it is not a requirement. It is a requirement if their income increases. Now, you need to make sure that this is addressed in your tenant selection policy, and you need to address it as it applies to your in-place residents. If you have a resident that's already there, and you have a lower set-aside come available that they could benefit from, do they get it first, or does your new move-in get it? So just make sure that you have a policy and that you've addressed that so everybody's aware of what that is. All right, so here's an example of a recertification. At move-in, the household income was $18,500. They're a 30% unit. When they recertify, their income is now $25,900. Their income is now increased, so that unit now becomes a 50% unit. So the next available unit that comes open has to be rented to a 30% to restore your balance that's required for average income. All right, we talked about the recertifications and that you're going to have to do that annually. All right, and we're going to monitor this annually to make sure that you're meeting this set aside. So every year when we do your file review, we're going to make sure that you're meeting your average income requirements. Now, this is important that you pay attention to this here. The average income properties use the MTSP rent and income limits published by HUD. That is important because those rent and income limits are lower than your traditional tax credit limits on a 40/60 property. So make sure that you are using the right rent and income limits. We mentioned your compliance department and how you need to like them and work together. This is a perfect example to where you need to know that information and make sure that you're working together. Because you can see on this example here, if you have elected average income, you notice that your 40% income limit is $16,880. However, if I'd elected the 40/60 set aside, my income limit is $18,880. If you're using the wrong income limits and you move somebody in at 40%, there's the potential to move somebody in that's over income. So you need to make certain that you're using the right income limits. That's why it's important that you have a copy of the executed 8609 with Part 2 filled out so you'll know what the owner elected. All right. We know before we ever get the 8609 because it's in their application. But it's important for you as the management company to know that so you'll know for certain how you're supposed to run that property. Now, not only are the income limits different, but your rent amounts are different. You don't want to be charging too much rent. That same rent limit for a 40% is $452 if you've elected average income. If you look at it for the 40/60 traditional allocation or the choice that the owner would choose, it's $487. All right, with the difference between $487 and $452 is not a whole lot of money if you're talking about just one unit. That may get you a half a tank of gas, all right? But if you look at that across your property, per unit, per year, how that could impact the property's bottom line. So make sure that you're aware that you're using the right rent and income limits because you don't want to charge somebody too much. Because one of the things that we would require you to do if you are doing that is reimburse the household for their overpayment of rent. All right, some additional things that we put in place as part of our rule that we changed in February when the new guidance came out is, of course, when the new guidance came out, there were some exceptions that the IRS said, all right, there are 5 exceptions that if they make a mistake, if it falls under one of these exceptions, you can allow them to make the corrections or you can work with them to make the corrections. That's essentially what this slide here says, and we'll talk more about what those exceptions are here in just a minute. So, your 8823, all right, if you tell us in RCRS, Unit 101 is a 30% unit. If we do a file audit and find out that that unit is in fact a 50% unit, that you have designated it incorrectly, that unit is reported to the IRS as over income because you designated them incorrectly. So you got to make sure before you're submitting these AOCs and your project activity reports that someone's double checking that to make sure that they've got it right. Right. So here's an example of how that would impact you on the 8823. You've got Unit 101. You've said that they're an 80% area median income unit, and the income limit is $33,760. You move somebody in, and their income is $41,600. Well, you already know they're over the income limit, so there's going to be an issue there. That unit is over income, and we're going to report that to the IRS as over income. So make sure if you have a unit that's over income, regardless of whether or not the property is still meeting their 60% average, it's going to be reported to the IRS as over income. So just make sure that you've got your designations correct. And of course, that unit's going to be redesignated to a market because there's nothing over 80%, and that's going to impact your calculation of determining whether or not you've met minimum set aside. All right? So, again, what else is happening here? The IRS allows market rate units, but does the state? So now not only do you have a finding with the IRS, you also have state noncompliance because now you have a market rate unit at your property and we do not allow those. All right? So here's a minimum set aside example. So 40% of these units are to be grouped to determine what your minimum set aside is. All right, so you see here, we're picking 40% of your units. You've got 5 units here, so 40% of that's going to be those 2 units, the 30% and the 50%. They're averaging to 40%. All right, so are you meeting the minimum set aside of 40%? Yes, because you've got to be at least 40%, so you're at 40%. All right. When the agency monitors your property, we determine that 103 is above a 50% designation that you chose. So what happens then? We actually find out that that particular unit is, instead of being a 50, is a 70. So what happens? Is your property still at 40%? It is still at 40% because what we did was we chose, instead of Unit 101 and 103, we chose Unit 101 and 102. So there's an example of where, although you may select certain designations for your units, if we can figure out a way to keep your property in compliance, we're going to work with you to do that. Now, we're going to reach out to you and let you know what's happened, but we're going to do what we can to help you stay in compliance to meet that minimum set-aside rule. Okay? All right. And again, everybody's still below the 60%, but your average is still good, so you're good with that particular unit there. All right. Now, in this example here, when you reach the minimum set-aside, 40% of the units are to be grouped to be part of the minimum set-aside. Again, 5 units. 40% of that 5 is still 2 units. All right, so your unit group average is 40%, but when we monitor your property, we determine that units 101, 102, and 103 can't be included in the minimum set-aside designation because they exceed what you've said they are. So then that means, what are your only 2 units left? 104 and 105. So those have to meet your minimum set-aside of 40%. Do those 2 average to 40%? No, they do not. They average to 75%. So what's happening at this property? You're losing all of the credits on this property. All right, so not just on those units, all of the units, because you have not met your minimum set-aside. So it's important that you know what those are. All right. Now, how do you fix this? Well, maybe you can fix it, because that's the next thing when we reach out to you and tell you that, because you're going to hear about this from us before we send you a letter, because it is not our goal for you to lose all of your credits. So we're going to work together to see what we can do to figure it out. So if you ever run across a situation like this, you will not find out about this from the first time from a compliance results letter. All right, you'll know before it ever comes, so you can let everybody know what's happening before it gets there, because you're going to start meeting a lot of people that you would not have otherwise probably met if they're going to lose all of their credits. All right, so what you can do, all right, possibly units 101 and 102 can be changed to the correct set aside. All right, but what does that mean? That means we're going to have to return your annual owner cert. In other words, we're going to have to reject it and send it back and allow you to make those corrections. All right, are we going to do that if it will prevent you from losing all of your credits? Yes. All right, but what happens when we return your AOC? When you resubmit it, it's now late, right? Would you rather get an 8823 for submitting a corrected 8823 for the AOC, or would you rather lose all of the credits on the building? So this is how we're working with you to fix this. So you need to make sure that you understand how this works, and whoever's handling this behind the scenes, that they know how to do these calculations for you. Because I will tell you, we are not going to be returning AOCs every year for every one of your properties, because you've got a data entry error or you've got all of these things. Now, obviously people make mistakes, we're human, but we're expecting you to be checking this before you're submitting your AOCs and checking your data entry and everything to make sure, because this is not going to be the catch-all for, we'll let them figure it out, and then if it's wrong, we'll ask them to reject the AOC. So if you have questions, make sure that you're asking that. All right, so this is some examples of how you could correct it. And again, if you regroup your units, you are at or below 60 at your group average, so you're still in compliance. So essentially you've corrected your information in RCRS, you've resubmitted it, you've resubmitted the AOC, and now your average is at 60%. So you've met the IRS requirement with your corrections, and you're good as far as it relates to the minimum set aside. All right, so here's another example. 40% of your units have to be part of the minimum set aside. All right, so in this particular example here, when we monitor, and again, we've chosen unit 101 and 102 for this example. All right, when we monitor, we find out that unit 105 is not actually an 80% unit. All right, so what happens when you have a unit that's over 80%? Becomes market, right? Does the IRS allow market rate units? All right, does the state allow market rate units? All right, so if you take that unit out of your mix, have you messed up your applicable fraction? No, because you're still at or below 60, because now you're just looking at 4 to figure your 40%. All right, yes, ma'am.
So does that mean you remove it from the numerator and the denominator?
Yes, her question is, if it's out of compliance, does that mean you remove it from the numerator and the denominator? And yes, that is correct. All right, so you're good with the IRS, right? What happens then? Who doesn't allow a market rate unit? So now you've got state non-compliance. All right, but have you got your applicable fraction of 100%? Because you got to have 100%, right? So what happens there? You've got a reduced applicable fraction that we send to the IRS. So if you've told them you're going to be 100% and you're not 100%, you potentially do have an issue with the IRS. So you see all of these variables that apply here that you've got to make sure that you're aware of, you're familiar with what applies to your particular property that you're looking at, and make sure that you understand what exactly it is that you're supposed to be looking for. All right, so here's an example of a minimum set-aside violation, meaning you don't have at least 40%. All right, so here's your layout of your units, your 100-unit property, and as of December the 31st of 2021, here's all of your units. All right, and your average is 57%. Is everybody good with the 57%? Is it at or below 60? All right, and are 100% of your units affordable? Based on that, what you know, everything's good, so everybody's happy, right? All right, so are you going to get reported for a minimum set-aside violation? No, because everything's good, all right? Now, in this particular example here, you notice that all of your units are noted, but you have 65 market rate units. What is your property average? 56%, right? Are you at or below 60? So are you averaging for the IRS? Are they happy with at or below 60? All right, so far we feel like we're good, right? But your minimum set-aside is 35% because you take those 65 units out of the calculation. So are 40% of your units now at or below 60? No, only 35% are because those 65 units came out of your calculation. That's another one of those examples that you will hear from us before you get our letter, because we're hoping that there are some issues somewhere along the way, maybe with some data entry, maybe you've got some grouping wrong that we can help you with, because the owner you don't want them to lose their credits on the entire property. We don't want you to lose any credits, but it's never fun to have to lose credits on all of the property. And I can tell you, as long as I've been at the agency, there's never been a case where that's happened. We've always worked with the owner to try to make that right. So we talked about some of the reasons that you could change the designation of the unit. Of course, if the IRS says in their rule, there's a federal rule that allows you to make a correction, we have to allow you to make the correction, also known as a change. If there's an agency permitted or agency required rule that's part of our public guidance, we will allow you to make that change or require you to make that change. All right, now, I'm going to show you, and I don't know how well you can read it in your book, but this is some examples of some of the findings that you will see in your letter if we find non-compliance with average income. All right, you notice in the language on the screen here on the left-hand side under the description, we're telling you that the average of the set-aside of 60% for each bedroom size as of December the 31st, 2022 exceeded 60%. And we're telling you what bedroom size was out of whack, whether it be 1 bedroom, 2 bedroom, 3 bedroom. So you know right there that is your issue. So you know what you have to do to fix it. Now, is the bedroom size average an IRS finding or a state finding? State. So this is going to be noted as a state finding on your letter, and it's not going to be reported to the IRS, but it is going to impact your ability to continue to manage properties and submit new applications. So you want to make sure that you get that corrected. All right, now here's another what's going to happen on your results letter. On this particular property here, we tell you again that your bedroom size exceeds 60% for your 1 bedrooms and your 2 bedrooms, and we tell you what that percentage is. But the part that we need you to understand is that you can't see these on your side until we send you this letter. Our system is not telling you this. We're expecting you to be able to calculate this and make sure that it's right. So if you have a software provider that can put this in there for you, that's amazing. That's great. Some of the management companies we've talked to said that their software provider is not there yet. All right. That's why when we were going through the slides earlier and I said, mark this slide so you'll know how to do this calculation. If your system won't do this calculation yet, you know how to do the actual calculation for yourself. And also, if you want to double check, formulas in Excel and things of that nature, you'll be able to know whether or not it's correct. So just know we're going to tell you what the percentage is, but you should be able to have something in place before you ever submit your annual owner cert to us to know whether or not you're meeting your percentage requirements as it relates to bedroom size, the property 60% average, all of those things. All right, so here's an example of what a minimum set aside. All right, so if we do a file review and it comes up that the property's not met the minimum set aside, that tells us that we're going to have to let you know you're going to lose all of the credits on your building or on your property. Our staff have been told if you have a finding that shows up like this, before you do anything, reach out to your team leader, reach out to Susan. We want to go through this together to see if there's another grouping of units that we can choose. Maybe there's a mistake that we could reject the AOC that they can correct, all of the things, because we don't want to send you a letter that's going to get everybody in a stir if it's not right. Having said that, there are algorithms that we have had put in place in our system. Maybe somebody keyed them wrong, and that's causing this finding to throw when it really shouldn't be. So there are several places on our side that we are double checking before we send this out. I can also tell you if a property is going to lose all of their credits, you will know about that before we send the letter. We will reach out to the management company and let them know so they don't get this letter and be like, what are you talking about? Because we want to work with you to hopefully figure out where the issue is at so you don't lose your credits. But our staff does know that if they get a letter that generates in our system that has that finding in it, it's all hands on deck at that point from our team because we want to do what we can to work with you to make sure it's right. All right. Does anybody have any questions so far before we actually go through some examples? All right. I did not bring my phone up. Yes, ma'am, Shannon.
I just want to make a comment that I appreciate that the agency is working very, I feel like, very graciously work with us, because obviously this is, it's definitely new, it's definitely a lot of risk, a lot of liability, and so I do think you guys are being very reasonable, and I appreciate it.
Well, I appreciate that. Her comment was that she appreciated the fact that the agency recognizes that this is new and that it's the risk that several people are taking and that we're willing to work with our partners to make sure it's a success for everyone, because ultimately the purpose of this is allow affordable housing to reach people in the market that are not otherwise met. All of us have had the situation to where we have had someone show up at our office and they're maybe $1,000, $200, $1,200 over the income limit, and you can't house them. But they don't make enough money to go out in the regular marketplace to afford to rent. You know, you think about first responders, police officers, you know, things of that nature. They make good money, but not compared to live in an affordable housing project. And they don't make enough money to go out and pay market where it's $1,400, $1,500 for a one-bedroom unit. So that's ultimately the purpose of this is to be able to reach more people that need affordable housing, but then also give the owner the opportunity to potentially increase their cash flow some. All right. So I did not bring my phone up here, so are there any questions? Okay, so there are no questions. So what we're going to do is we're going to switch over and go over our examples. So if you will turn in your books to page 175. Okay, so on page 175 in your book, all right. First, let me make a couple of disclaimers. All right. These examples are very basic. I'm sure every one of you that has elected average income or has average income on your property is probably thinking, oh, it's way harder at my property. And it probably very well is. But we wanted to make this as easy as possible to understand before you started adding all these complexities to it. All right. So on Happy House Village on page 175 in your books in the back, all right, you will notice something that looks similar to a project activity report in RCRS. All right, so what we did was we printed a project activity report out of RCRS. You notice I took tenants' names off of here and other information that needed to remain private, but then also wasn't pertinent to what we were talking about for this example. All right, so in this particular example, we're only looking at the last column that says applicable set aside. So the owner of this property has worked with the management company throughout the year. They've entered their information in RCRS, and they're happy with it, and all of their set-asides are noted over in that far right-hand column. All right. Well, you notice in the system is not telling you what that average is, right? So someone's having to calculate that. So that's where your math is going to come in at. So based on this project activity report, everybody feels good about that from the management company level. RCRS information is great, so we're going to submit it, and we're going to go celebrate because it's the end of the year, and we're ready to be done with it. All right? Well, then if you look in your book on page 176, the last two columns, you will see that we have done a file audit on this property. All right? We've told you, based on the file audit, what we found out to be your set-aside. All right? And if there are any finding notes. But you notice down at the bottom, we've added the calculation to this sheet here. All right, our system calculates that, but for example purposes, I wanted to put it on here. All right, did we have any findings? based on this information that you have here? All right. Are you at or below 60? Everybody's happy at Happy House, right? All right. Life is great. All right. Now, the next page is Fremont Village. All right. This in your book is probably going over to 2 pages, maybe not. I don't know the sizes because there's 24 units at this particular property. All right. When this one, when you submitted this project activity report to us, you notice that you're telling us your average is 60%. All right. Are they at or below 60? How do you feel about that? Y'all good? 60% you're allowed, as long as you're at 60 or below, are you good? How many of you would prefer a cushion? All right. Give me a little margin for error, because I understand. But again, your management company or your owner needs to be the ones determining whether or not you have that margin of error that they want you to use. Because if you start renting more at your lower set-asides, that's impacting the rent that you can charge, which then impacts the cash flow. So, again, if it were me, I would want a little bit of a cushion. I wouldn't want to be right there at 60 all the time. Some people like to push the envelope. That's not me, not in this situation right here, especially if I'm going to have to be the one write the check back if I've got it wrong. All right, so keep in mind, life is great. Y'all think we're at 60. I'm going to try to change this on this screen. All right, now we're at Fremont Village, and we've done a file review. All right, and you notice on the right-hand side on the screen, we've told you what set-aside we found during our file audit, and we've made some finding notes. All right, again, just going through, simply following the applicable set-aside column. All right, and this is essentially what we do when we do a file review. We go in and process that file as if they are a new move-in, just like you would do at your property, and then we're making notes in the system. So this essentially is what someone's done. All right, so you see that we have 7 units that we found findings with, whereas you told us it was one set-aside and it was another set-aside. What happens to those 7 units? Do they get reported to the IRS? And they're reported as over income, correct? Because you told us they were 30 and they were 50, or you said they were 50 and they were 80. All right, so you've got these 7 units. All right, well, at Fremont Village, you have 24 units. How many units do you have to be in compliance in order to meet your minimum set-aside? 40% of that, right? So that's 10 units. So if you take 7 units out offline or out of the calculation, instead of having 24 units to use, you now have how many units to use? 17, right? Have you met your minimum set-aside if you've got 17 units in compliance? Yes, because you only have to have 10. 40% of 24 is 10. It's actually 9.6, so you round it up to 10. You've got 17 there. All right, so is there a minimum set-aside violation? No, because you've got the minimum that you need. So the owner's not going to lose all their credits, but we are going to report them to the IRS for being over the income in their units because they said they were 30s and they were 60s or vice versa. Right? Do you have any state noncompliance there? Is the state going to ding you for that? Or is it just going to go to the IRS? Nothing's became a market unit. All right, so right now in this example, you're only going to be reported to the IRS. There's no state noncompliance here. All right, so then how do you correct this? That's what people always say when we send them letters. What do I need to do to correct this? Well, you're going to have to do an update unit event and recertify the household, or somebody's going to have to move out, and the new household that moves in is going to have to qualify. But yes, you can do that, but in order to document that, you're going to enter unit events in RCRS with the supporting documentation, whether it be via a recert, an update, or a move-in. So yes, it can be corrected. So, and I think in your book, we also have an example of the 17 units that are still in compliance now. All right, so now we're going to go to Franklin Village. all right? This property has 18 units. So in order to meet the minimum set aside, 40% of 18 is 7.2. So you got to have 8 units in compliance to meet the minimum set aside, not to lose all of the credits. All right, so here's your property, all of your units, and when you submit this to us, let me see how this is going to work. You notice that we tell you in the book that their average is 59%. All right, but let me ask you this. Do you notice anything different about Franklin Village versus the other properties? Yes, they've got 2 bedrooms and 3 bedrooms. So now you've got to do more than just one average calculation, right? So you do the average calculation per bedroom size. You notice that your 2 bedrooms average to 59%, but your 3 bedrooms average to 61. Do you have state non-compliance there with your 3 bedrooms, right? So you're going to get state non-compliance for your 3 bedrooms not meeting the average. All right, so that's the first thing for your state non-compliance. All right, then you're going to see our finding notes. Again, strictly looking at the applicable set-aside. You told us it was one thing, we did a file review and found out it was something else. Well, at this particular property, you notice that there are 5 units where the owner said that they were 80%, but we actually determined they were not 80, they were over that, so they're now market, right? So, all of these units here that are listed here, are they going to be reported to the IRS as over income? Yes. But what is the other issue you're going to have here that you did not have with the other one? Who doesn't allow market units? Right. So you're not only are going to get an IRS finding for units over income, but you're going to get a state finding because now you've got market rate units and we do not allow market rate units. Okay. Well, the other thing that you're going to have to look at is how many units are out of compliance. There's 11 units out of compliance, right? How many did we say that you got to have in order to meet the minimum set aside? How many are in compliance? 7, right? Because 11 plus 7 is 18. That's your total unit count. This is going to be a phone call about not meeting the minimum set aside and losing all credits. So you've got several issues going on here. So you see the different complexities of the different things that you have to look at. So just make sure that you understand the calculations and how those come about. That way maybe you can go back to your office and help your team figure out what's the best way to get these calculations in place so you don't have to do it manually. All right, now, the last example we're going to talk about is Lottery Lane. All right, and at Lottery Lane, this particular property has 8 units, although I tell you at the top it has 18. My math wasn't good that day, so there's 8 units, all right? So you notice everybody moved in 2021, and everybody qualified. Life was good. You go a whole year, and nobody moves out, and you recertify everybody. Now at recert, people's income has gone up, different things have happened, so their set-aside has now gone up if it's applicable. In our example, we're saying their income has gone up, they're now a higher set-aside. For example, unit 106, they were a 50 when they first moved in. They've evidently got a hefty raise, so that now they're an 80% unit. All right, so everybody's still there. Management did a great job. They've calculated the income. They've double-checked everything. Everybody qualified at move-in. Everything's right at recert. What's wrong? Their average is 65%, right? Did anybody do anything wrong to get to that 65%? Management did what they were supposed to do. The residents did what they were supposed to do. They gave you all the right information. This is considered known non-compliance. This means it just happened, nobody did anything wrong, and we know it's non-compliance. So, obviously you can't make people move. We don't want you to make people move. All right, but what has to happen is you have to get this property back in compliance as soon as possible. Now that means when somebody moves out, you've got to move the next person into a unit of the same size or comparable size at your lowest set aside at the property to bring that average down. All right, so we have people saying, Well, if I move somebody out of an 80% unit, have I got to rent that to a 30% if an owner elected a 30%? Yes. All right, because you've got to get that set aside back down. But now you've also got to remember that all the while these residents have been there, every time their set aside increased from maybe a 30 to a 50, their rent should have increased from a 30% rent to a 50% rent. So you're making that up along the way, all right? So the likelihood of you, quote unquote, losing money because of this is very slim. You're going to have multiple people moving out, especially if it's a family property. People like to move, not me, but some people like to move, and you're going to have people moving in and out. So you've got the opportunity to get your set aside back where it's supposed to be at. Now, yes, it's known noncompliance. We're not going to put this in a letter to you, but we know on our side that it's known noncompliance. So the next time we do your file audit, we're looking at your move-ins. Yes, Shannon.
So, on that unit 50 who goes up to an 80, we're doing their research a couple months out. We're telling them, hey, by the way, now you're qualifying at 80, and your rent has just gone from, 600 to 750, but now you're at 80%. And they come back in, oh, wait, that's my side hustle. I'm quitting my side hustle. I need you to redo that paperwork and keep me at my 50. Am I doing that before I send that up to you? Am I doing that, or am I just saying, sorry, this is what it is, you're going to 80, and then they're going to move out, and then I'm going to run it back to a 50?
Okay. Her question is, it's time for research. You tell the household you were a 50, you've got a nice raise, now you're going to be an 80, your rent's going to go up $150. They then decide, oh, no, that's my side hustle. I'm not working that anymore. I'm not going to be an 80. All right. If you know that prior to telling us that, you need to go ahead and do the research accordingly, but make sure you document it. You've got a clarification statement. You've reached out to the employer, and the employer says, yeah, you're right, they're not working anymore. Or you can show they don't have that gig income anymore, okay? Because this happens even on an average income property. People figure out their rent's going to go up. All of a sudden, they figure out things that they're not going to have to do anymore, so they don't have to pay that. And I can appreciate that. But document it beforehand if you know it. Now, what's going to happen? They're not going to tell you. They're going to go a couple of months, and they're going to be like, ooh, this is too much. They're going to quit that job, and then they're going to come back and tell you, can I get that 30% back, or can I get that 50% back? What does your tenant selection policy say? All right?
We do annuals.
So that's where it goes back to your tenant selection policy. And have you already rented that unit that came vacant to somebody else? Or did a unit not become vacant and they got the 80% and your management company says, I'm not the housing authority, I'm not back and forth with you every month because you quit a job, start a job, and all of that. That's why it's important that you address this in your tenant selection policy. So, because that very well does happen all the time. Yeah.
Sandy, have you guys had any other company that has income average income that has already gone through the whole recertification process?
The question is, do we have any other companies that have gone through the recertification process that have average income? And the answer to that is yes. And no, there was not. I don't recall any non-compliance, but of course, I don't see everybody's letters. Susan, are you aware of any of the properties that elected average income that we found non-compliance on them?
No.
Yeah.
Income levels don't typically change that drastically. So.
Yeah. So most of, all of the file reviews that we have done thus far, I will tell you, we had some issues on our system that were wrong. So it's throwing all of these findings, and our staff are like, what's going on here? Why is it throwing all these findings? I don't think it should be doing this. Come to find out, we made some mistakes on our end. Our IT team put the algorithms in there incorrectly. It was throwing it all over the place. So if you guys see that, that's where you need to come back and tell us, hey, I don't think this is right. That's why we want to communicate with you and make sure you're part of the process, because we can very well make mistakes on our side. But as a general rule, I don't, when letters were first at the beginning of the year, they were all over the place. I'm like, this cannot be happening, because if this is a sign of things to come, nobody's going to like us, But again, so we figured out what it was. Again, it's some learning curves for us too. So, but yeah, so far it's been good. All right, now, what I do want to do is go back and point out some things on these project activity reports, okay? Because you notice that I said with these project activity reports, we're only looking at the applicable set aside. All right, but let me see if I can get back to the one for Happy House. All right, if you notice, on Happy House Village, Unit 5005, Unit 104, they said that their income limit was their income was $66,398. How close is that to the income limit of $67,360? When y'all look at this project activity report before you submit your annual owner cert, what are you doing? You're going back and looking at that file and looking at everything and double checking, right? Keisha said a couple times in different presentations, are we going through their trash? Are we following them to work and make sure they're doing what they're supposed to be doing? That's exactly what we do when we get your annual owner cert. We print your project activity report as of December the 31st, and we look for these things. All right. The other thing you'll notice on Unit 106 and 108, we tell you that it's a move-in event, but your last cert date doesn't match the move-in date. All right, so again, those are different things that show up as part of your project activity report that you can catch on the front end by looking at that. And again, these are things that we're looking at when we're doing your annual owner cert review. Now, on several of the other ones, if you look at Fremont Village, let's go to Fremont Village and then we'll move on, but I wanted to point this particular one out. Did I pass it? All right, look at Fremont Village, Unit 5005, Unit 206. Whoever entered this information into RCRS said that person's income was $75,846, but we told you the income limit is $50,880. You know before we ever look at this file, this household is over income based on what's on this project activity report, right? You should be double checking this before you send this to us at the end of the year via question number 18 on the annual owner cert. Question number 18 on the annual owner cert every year for the last 100 years, I think, has said, I am certifying that the information in RCRS is true and correct as of December the 31st. All right. If I had to guess, this right here is a data entry error. Somebody just needs to make the correction on it. Oftentimes we see they put too many zeros. It's not actually just this case here. So that's some of the things that we wanted to point out that we look at as part of average income, but also show you how that ties back to the annual owner cert and what we look at when we're reviewing that. All right. Does anybody have any questions about average income? I did not bring my phone and feel like they're... Oh, there's no question. So either everybody's in shock or we've done a great job. So we're going to go with the great job thing. Okay.